Over 2 million Canadians are set to renew their mortgages over the next year. They're about to do so at rates that are higher than anything they've ever seen before. But here's the truth. I think that most Canadians are about to choose the wrong mortgage strategy. In this video, I'm going to explain to you what a smart Canadian should be doing instead and how to avoid locking into something that you're just going to regret. So the average Canadian thinks that a 5-year fixed rate mortgage is the smartest choice for their mortgage term. But new data that just came out of CMHC's spring published report, it might say otherwise. This report itself shows that a lot of Canadians are shifting their decisions, and it could be actually for good reason. In this video, I'll explain exactly what the report said and if it makes sense for you to consider changing your strategy as well. The report in spring showed that the average Canadian is starting to shift away from the typical 5-year fixed rate mortgage. In an interview and a video from CMHC's head economist, he mentioned that we're seeing a third of borrowers actually make the move away from fixed rate loans into variable rates. Another third of borrowers in this report suggested that they were taking shorter term, like 1 to 3 year fixed rate loans, with only 1/3 of Canadians taking the traditional 5-year fixed rate model. Now, this all matters because Canadians are now in $2.3 trillion of debt, which is the highest in the G7. And the thought process is that borrowers right now are trying to stay as flexible as possible based on the assumption that interest rates are still expected to fall in 2025 and 2026. Again, the thought process in this study is that average Canadian is saying that choosing a shorter term right now is allowing them to stay more flexible during these potential drops so that they could take advantage of them and restructure their loans before the end of term. Now, whether you believe that's right or wrong, there is a myth. And the myth is that the 5-year fixed is the lowest possible term option, and the 5-year fixed is also the safest route to go. The reality is that mindset, based on this report, it could be outdated, and that could actually cost you more money than you actually earn. And that could actually cost you more money than it's going to save you if you think that way going forward. Believe it or not, a lot of Canadians locked into a 5-year fixed rate at 5.5% plus in 2022 and 2023. And the thing is, with posted rates dropping, prepayment penalties have gone up dramatically, which means tons of them are actually stuck in high rate terms and paying thousands of dollars of extra interest. An example of that would be a 5.5% loan locked in over the next 2 years when compared to a 2-year fixed at 4.5% could mean the difference of literally $6,000 over the next 2 years. Locking in for too long and too early could actually end up meaning a loss of thousands of dollars, which is exactly what's happening to a lot of Canadians right now who locked in 2022 and 2023. So here's exactly where I think that smarter Canadians, or savvy Canadians, if you will, are getting ahead right now. And I'll be clear, a lot of this is stemming from the CMHC's report, and this is data that they're providing to us. The short term, the traditional 1 to 3 year fixed, which we're seeing making a comeback right now, is making a serious comeback. And Canadians are locking into 1, 2, and 3 year terms, looking for short-term stability, but with an opportunity to restructure or refinance down the road. Basically, they think that rates are going down and they want that flexibility in their lives. The second is the variable rate mortgage. Particularly those who are taking an adjustable rate term are looking at the possibility of taking something that's floating, assuming they're comfortable with cash flow being potentially higher or lower, depending on what the BOC does for the next 5 years. And this is because they can lock into a lower rate term and or ride the market down if rates continue to go down. By choosing the 2 or 3 year terms, the idea is that borrowers were aligning themselves specifically with timelines at which they were expecting the BOC to cut rates. Now, depending on which side of the fence you are on, you might not believe the BOC will continue cutting rates, so that could be a risk that people are employing right now. And this is the biggest one, particularly with 2025 and 2026 renewal crisis at hand, is a lot of Canadians are starting to manage their renewals much more effectively. In fact, looking at early renewals and even exiting and paying out prepayment penalties to save money now and or early to lock into the market right now today. So this is the 3 things that Canadians are considering when they're looking at borrowing money right now. Number 1, CMHC noted a 41% increase in variable rate mortgages in February of 2025 compared to the previous year. Another 2/3 is picking short terms, 2 to 3 year terms, which is up 30% year over year. All of this data is again suggesting that the average Canadian is expecting and waiting for the potential for rates to fall. Even though mortgage delinquency itself remained low in 2024 at 0.21%, it's expected to actually increase as people are renewing at higher interest rates, which means average Canadian is concern about economic uncertainty. And a lot of decisions right now are being made based on the concern of higher monthly payments and higher debt. This is putting a lot of pressure on Canadians to make a better decision when it comes to the renewal time. With more than 2 million mortgages coming up for renewal between 25 and 26, this is putting the average Canadian at a serious crossroads as to how to make a mortgage decision. And they're going to have to consider the economics in the marketplace, their current financial status, how much debt they're carrying, and how much that monthly payment will impact their lifestyle. This is why we believe that the reports are showing that the average Canadian is considering a shorter term or a variable rate mortgage to watch the marketplace. If your mortgage is coming up for renewal and it's time for you to make that decision, there are 3 factors that you should be considering when determining which third that you sit in. The first is your income and the stability of your income. Whether or not you believe that your salary is going to remain the same, increase, or there are any concerns of that going away in the near term. The second is any upcoming changes in your lifestyle. This could be obviously family growth or family reduction, changes in your life and where you're living, or any other major expenses that could impact your life in the next 2 to 5 years. And the third, while it might be obvious, it's not for a lot of people. It's how long you're staying in your home. Your lifestyle can impact how long you stay in your home. Your family can impact that, but there are also other considerations like just genuinely planning for when you're going to make that upsize. And the reason that this is so impactful is because not only is the rate market shifting, but the average Canadian continues to spend way too much money in things like prepayment penalties, which is how we started off this episode. When you consider that the average mortgage term lasts between 3.8 to 4.2 years, that's 4 years out of a 5-year fixed. Outside of trying to time the marketplace and when rates are coming down, the next biggest decision that you need to make is when you're going to break that term. And if you don't know already, the average Canadian ends up paying literally tens of thousands of dollars in breaking their mortgage terms because of high IRD penalties. Basically, to summarize the CMHC report, the average Canadian has been more focused on timing the market and looking for flexibility versus cost certainty. If you're a Canadian and you own a home and you're trying to decide right now on if it makes more sense to go that flexible, short-term, long-term route, consider those 3 factors that I shared with you earlier in this video when trying to determine what length of loan term you should be going with. And if you haven't done so already, click in the description below where you can get a whole bunch of different calculators to help you plan this all out. And if you're still concerned, we track the swap rates every single day to show our clients exactly where the market is right now and help you build a plan for the future. If you found this video helpful, click the thumbs up and we'll see you on the next one.